Imagine you're sipping coffee, scrolling through your news feed, and suddenly, headlines scream, "Financial markets in chaos." Sounds familiar? You're right. But here's the twist. It's not 2008. It's 2026, and this financial hurricane has a new architect: private equity. Welcome to a world where the players have changed, but the game feels eerily the same. In 2026, the stage is set for a financial drama that mirrors the 2008 crisis, yet with a subplot few saw coming. It revolves around private equity firms aggressively dumping their gargantuan debt loads onto public markets. Let's break it down. Picture this. Private equity funds, the shadowy powerhouses behind some of the biggest companies, have been on an epic debt binge. They've leveraged massive sums to acquire companies, restructure them, and sell them for quick profits. But here's the catch. All that debt? It didn't disappear. It's lurking, ready to explode onto the financial stage. And just like that, public markets become the unwitting depositories of unsustainable debt. The pressure mounts and bam, like a financial time bomb, we're staring down another global financial meltdown. Intrigued? Let's dive into how we got here and why 2026 might be the new 2008. Now, let's peel back the layers of this ticking financial time bomb. Imagine private equity as the silent puppeteer, orchestrating behind closed doors, while many of us remain blissfully unaware of the show unfolding. Over the last decade, these entities have been on a feeding frenzy, buying up companies across every sector, from retail giants to tech startups. Here's the kicker. Most of these purchases are heavily leveraged. In simple terms, that means they're buying with borrowed money, mountains of it. This may sound like a Wall Street thriller, but it's real life, and yes, it's happening right under our noses. The companies acquired are burdened with this debt, and the risk is immense. Fast forward to 2026. This unsustainable model hits a breaking point. Private equity firms, eager to shed liabilities, start offloading these debt-laden companies back onto public markets. This is the debt-dumping tsunami. A chaos infuses the market as investors scramble, unsure of what assets are solid and which are sinking. You may wonder, why hasn't this destructive cycle been curbed? Isn't there a safeguard? Strikingly, oversight has lagged behind innovation in finance. Laws that seem ironclad today quickly become relics to the savvy, agile strategies in high finance. Will history repeat itself, or can we rewrite the ending? Keep watching as we unravel what could really happen come 2026. So, you might ask, what's the defense against this impending financial storm? Why aren't regulators stepping in before it's too late? Well, here's where things get intriguing. At the root of the issue is the complexity of modern finance. Regulations conceived years ago are no match for the intricate web of financial maneuvers woven by today's market wizards. Private equity operates in a realm often just dimly lit by regulatory oversight. With rapid advancements in financial instruments and the global tide of investment, by the time rules are in place, the game has already evolved. It's a relentless cat-and-mouse chase with enormous stakes on the line. Now, recognize the ripple effect of this impending crash. When private equity debt starts flooding public markets, it hits pension funds, mutual funds, and the portfolios of everyday investors. It's like dominoes set to topple, affecting anyone with a foot in the financial world. Interest rates could spike, asset values plummet, and suddenly, the ghost of 2008 becomes very, very real. We've been handed the knowledge from past mistakes, yet the question lingers. Will we act or continue in complacency? Are we, as a global financial community, prepared to confront the volatile dance of risk and regulation head-on? Stay with us as we explore how we can brace for what may be the fiscal storm of the century. Now, let's pivot to something you might not have considered: the human element. Every financial crisis isn't just a story of numbers, it's a saga about people. Picture this: folks waking up to headlines that throw their future into uncertainty. Think of those pushing retirement closer each day, suddenly realizing their 401ks are teetering on the brink. The anxiety, the unforeseen stress, it's a domino effect that extends from Wall Street right into our living rooms. And then there's the wider economic canvas. Businesses struggle, unemployment rates spike, and the lending markets tighten, creating ripples that echo through every corner of society. It's a recipe for uncertainty, shaking the confidence of even the most seasoned economic optimists. But let's not get swallowed by the doom and gloom just yet. Many argue that this forecasted storm presents us with a unique chance, a chance to rethink, to innovate, to transform how we engage with our financial systems. There's a growing clamor for transparency, ethical investing, and sustainable financial practices that could redefine the landscape. Imagine a world where finance isn't just a survival of the fittest, but an ecosystem where growth doesn't come at the expense of stability. Together, let's explore how we might make that vision a reality. What changes are crucial? What steps await us on this fragile but hopeful path? Stick around as we uncover how to shape our future away from the shadows of the past. So, in this delicate dance with destiny, what can we as individuals actually do? Let's zoom in on tangible steps that aren't just high-level theories, but practical actions we can all take. First, financial literacy is your best defense. The more you understand about where and how your money is invested, the better equipped you'll be to make informed choices. It's like getting the real map of a financial jungle you're traversing. Look into your retirement plans, question what's in your portfolio, and educate yourself about the companies that comprise them. Second, embrace diversification. Don't put all your eggs in one basket. Mix your investments across different sectors, regions, and even asset types. It's the classic play against market volatility that helps protect your nest egg from being wiped out by industry-specific downturns. Third, demand accountability not just from financial institutions, but also from policymakers. Engage in conversations about transparency and ethical practices. It's time to advocate for regulations that keep pace with innovation. The truth is, change begins with awareness, morphs into a shared resolve, and fans out into concrete action. As we venture closer to 2026, let's not be passive participants in this financial narrative. Together, we can help build resilience, turning potential fallout into a foundation for a more stable economic future. Finish this journey with us as we forge a path towards informed financial stewardship. As we stand on the brink of what could mirror the financial chaos of 2008, the narrative we choose to write now will echo through economies and personal lives alike. This is more than just a financial story. It's a call to redefine our economic landscape with intelligence, responsibility, and foresight. Here's your call to action. Start today by taking stock of your financial situation, educate yourself, diversify, and demand transparency from those managing your investments. Your financial future is not just in the hands of global markets or towering firms. It's in yours, empowered by the choices you make now. Let's walk into this uncertain future with eyes wide open and equipped to craft a narrative of resilience and opportunity. Remember, in the face of uncertainty, awareness and action are our greatest allies. If this resonates with you, share this video and let's create a conversation about safeguarding our financial tomorrows today.